What goes up must come down. The bigger they are, the harder they fall. Everything must revert to the mean. Use whatever cliche you want. It really doesn't matter. You came here for the truth, so let me unveil that for you. Today, I want to show you something I found very important. I'll cover it quickly and concisely. Let's begin. These are moving averages. For those who don't know, moving averages are an expression of price in relation to time. I've covered the 50-day moving average, the 200-day moving average, and these are basically technical analysis indicators that you'll see traders using and others using to predict what's going to happen in any particular stock or any market. Okay? Moving averages are always worth watching. They often present key market pivots or turning points. They can be support or resistance. Okay, so this is technical analysis, and many people just focus on technical analysis to be able to predict where things are headed. And I think this is very, very short-sighted. Then there are others who just look at fundamentals. And I think that's just not a smart thing to do. You need to take everything, piece it together, and then call it the money GPS. That's the way I like to do this. Take it all. Psychological side, I want to know the fundamentals, I want to know the technicals, I want to put it all together in a nice little package and decide for myself where I think things are headed. Okay, so that's what we'll do. Today we're going to focus on this. I thought it was very convincing when I looked at it because it has to happen. You'll see what I mean in a moment, okay? Look at this. We're looking at the 5 exponential moving average. We're looking at the 5 EMA, all right? It is relevant on any time frame. Take a look at the SPX, all right? You're looking at the stocks. And you'll see basically tracking it perfectly as time moves on, right? And what they note here in this paragraph is that sometimes it falls out of this 5 EMA. But it's very important, price always reconnects. Let me re-emphasize, price always reconnects. So what does that tell us about what's happening today? Obviously, that's what you came here for, right? So you'll see this going on. I'll just move on quickly to show you some of the examples. We don't have much time today. Microsoft right now is 26% above its 5 EMA. If you can't see it, it's literally off the chart. This happened to reconnect with its annual 5 EMA every single year except 99 and 2017. Sound familiar? Same thing. Apple, 26% above its 5 EMA. Again, way out of whack. Now, does that mean that this is necessarily going to come back tomorrow? No, but take a look, just as a few examples. So you can see this red line for a moment here, and look how it falls out of place and then finds itself back in that space. Falls out of place, finds itself back in. So I don't know where it's headed exactly, but it has to revert to the mean. Again, Amazon, 34% above its 5 EMA, way out of whack. You can see that. But don't just think it's a big cap tech. Look at this. Caterpillar, 29%. MCD, BA, we're looking at all these, doesn't matter. And the All World Index as well, for reference, there it is. Dow Jones, essentially the same situation as the S&P, right? We're looking at these stocks that have gone into new heights caused by central bank intervention. Things are completely out of whack. This right here just showing you the same thing, SPX. The NYSE, whatever you want to look at, okay? It doesn't matter. And then on the opposite end, we have the VIX, showing us here at approximately 8. Its lowest start to any year following the lowest quarterly and the lowest annual close ever. It's just, how many different charts do we have to see proving the exact thing? Now, did I tell you that stocks are going to go down? No. I can probably make a wager that next month stocks will be higher than they are today. It's a good guess. Probably going to be the case. But what does it tell us about the fundamentals? We need to connect all these pieces together. It's pretty simple when you think about it. Central bank's intervention causes share prices to go up. But ultimately, we could see change in that because we know that the central banks are claiming that they want to increase interest rates. That's going to cause a massive problem for the national debt. That's going to cause problems for the homeowners and all of this different credit cards and student loans and everything else that's on a variable rate, or when they have to refinance, which has to come up eventually. This is all interconnected. You can't fool this, right? This is going to be a big problem. When? You tell me. You're the guru. All right, that's it for this video. If you found it informative, please give me a thumbs up. If you like this particular indicator, then give me a thumbs up. If you hate my face, if you hate the VIX, if you hate the numbers 1, 2, 3, if you hate sunshine and rainbows and flowers and let's see, Janet Yellen's face and the letters A to Z, then give me a thumbs down. All right, that's all. If you found the video informative, I know you'll find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. Links are in the description below. Take care.